In the semiconductor industry, there are markets where competition is fierce, and markets where it is not. DRAM is not. Three companies, Samsung, SK Hynix, and Micron, have controlled over 90% of global supply for 3 decades. No new entrant has broken through, not from Japan, which once dominated. Not from Europe. Not from Taiwan, whose foundries lead the world in logic chips but never cracked memory. The last time the DRAM market had a meaningful new player was Samsung itself. In the early 1990s, think about that. In an industry defined by disruption, the memory market has been a closed shop for a generation. Now something has changed. A fourth player has entered, not at the frontier, at the commodity base, exactly where the incumbents are leaving. This episode is about what happens when a monopoly opens a gap at the bottom and a new player fills it at speed. Speed is impressive. But speed and position are not the same thing. The gate between commodity DRAM and AI-grade memory is where this story turns. CXMT, Changxin Memory Technologies, founded in 2016 in Hefei. Anhui, for years dismissed as a niche player making low-end DDR4 for consumer electronics. That characterization is now obsolete. The numbers are extreme, and that is the point. 2022 revenue, RMB 8.29 billion, loss of RMB 8.33 billion. 2023 revenue, RMB 9.09 billion, loss of RMB 16.34 billion. 2024 revenue, RMB 24.18 billion, loss of RMB 7.15 billion. 2025 revenue, RMB 61.8 billion, first profit, RMB 1.88 billion. 2026 Q1 revenue, RMB 50.8 billion, up 719% year-on-year. Net profit, RMB 24.76 billion, up 688%. H1 2026 guidance, revenue RMB 110 to 120 billion, net profit RMB 50 to 57 billion. More profit in 6 months than the previous 3 years of losses combined. Global DRAM market share, from 3% in Q1 2025 to 8% in Q1 2026, a near tripling in 12 months. Semi-analysis project CXMT could surpass Micron to become the third largest DRAM producer by late 2026, 17% global share by 2028. On July 16, CXMT will price its IPO on the Shanghai Star Market. RMB 29.5 billion raised, second largest in Star Market history, behind only SMIC's RMB 53.2 billion. The review took 165 days. A speed record for a large hard tech listing. The chairman, Zhu Yiming, has pledged not to sell shares for 10 years. 768 million shares allocated to employee incentives. A 10-year lockup from the founder. I have not seen that in any major Chinese tech IPO. The numbers are stunning. But numbers without context are decoration. Let me show you why CXMT grew this fast and why the growth tells you less than most people think. CXMT did not break into a closed market. It filled a gap that the incumbents opened on purpose. Here is the structural move. Samsung, SK, Hynix, and Micron are not defending their DRAM market share. They are converting it. DRAM capacity is being redirected toward HBM. High bandwidth memory, the AI-era memory format that commands significantly higher margins and is growing at roughly 70% year-on-year. HBM now consumes roughly 23% of total DRAM wafer starts. Every wafer allocated to HBM is one less wafer making commodity DRAM. The result? A structural shortage in commodity DRAM even as total DRAM output rises. This is not a demand shock, it is a supply reallocation. DRAM contract prices rose 60-70% in 2025 and another 30-40% in H1 2026, not because smartphones suddenly needed more memory. Because the three companies that control supply chose to move their best capacity to a higher value product. CXMT filled the hole. It does not make HBM. It makes LPDDR and DDR, the commodity formats the three incumbents are deprioritizing. In 2025, LPDDR accounted for 66% of CXMT revenue, DDR for 32%, commodity DRAM, 99% of total revenue. This is the key insight. CXMT's explosive growth is real, but it grew in the space the incumbents vacated, not in the space they are defending. When Samsung moves a production line from DDR4 to HBM3E, the DDR4 supply tightens, prices rise. CXMT benefits. But it benefits from the incumbent's strategic choice, not from a competitive victory. The incumbents moved upstream to HBM, to AI-grade memory, to the part of the market where margins expand. CXMT moved into the space they left, commodity DRAM, thinner margins, closer to a commodity. The velocity is real, the position is different. Over 30% of Chinese Android phones now use CXMT LPDDR, expected to approach 50%. Real customer wins, but all in the commodity layer. No customer is buying CXMT HBM. Because CXMT does not sell HBM, not yet. Now, let me show you the gate. HBM is the memory architecture that makes large AI model training economically viable. Every NVIDIA GPU shipped today requires HBM. There is no substitute. SK Hynix dominates HBM3E supply to NVIDIA. Samsung is the second source. Micron is ramping. These three control the technology, the yield, and the customer relationships. CXMT's HBM position. At the end of 2025, CXMT's HBM monthly capacity was approximately 5,000 wafers, less than 2% of its total output. HBM3 high yield, roughly 25%. SK Hynix's HBM3E yield is reported above 70%. The gap is not incremental. It is structural, and here is the number that stopped me. CXMT's IPO prospectus RMB 29.5 billion in proceeds contains zero dedicated HBM investment. The prospectus allocates RMB 75 billion to production line upgrades, RMB 130 billion to DRAM technology advancement including DDR5 and LPDDR5X, RMB 90 billion to forward-looking technology R&D, which mentions HBM3 and HBM3E research and pilot production. But no dedicated HBM capital expenditure. None. This is not an oversight, it is a signal. Research is possible with the tools available today. Mass production is not. CXMT is investing in the run-up to the gate, not through the gate. The RMB 90 billion in R&D is the cost of standing at the gate and learning how it works. It is not the cost of walking through. The gate has 3 locks. Lock 1. Process yield. 25% means 3 out of 4 stacked devices fail. Each failure consumes expensive wafer area. The economics do not close at 25%. Lock 2. Manufacturing equipment. The advanced lithography and bonding tools required for HBM volume production are not available to CXMT at scale. Research is possible. Volume production is not. Lock 3. Customer qualification. NVIDIA qualifies HBM suppliers through a rigorous process that takes 12 to 18 months. Even if CXMT could produce HBM3E at competitive yield, it would need to pass NVIDIA's qualification. A gate controlled by the customer, not the producer. 3 locks, each one independently sufficient to keep CXMT on the commodity side. This is the memory disconnect. The fastest growing semiconductor company in China, a broken 30-year monopoly, the second largest IPO in star market history, and the highest value, fastest growing segment of its market sits behind a gate it cannot yet pass. Let me pull this into the framework we have been building. Every episode in this series traces the same pattern. Value accumulates at the gate, not at the finish line. The exit gate when you arrive matters more than whether the gate opens. The capital gate who holds the key determines who captures return. The velocity gate speed gets you to the gate. Position determines whether you walk through. The permission gate access is not permission. Now, the memory gate. Commodity DRAM on one side, AI-grade HBM on the other. 3 companies hold the keys. CXMT stands outside, growing faster than anyone expected. But growing in the space the key holders chose to leave. 3 positions in the memory chain. Position 1. The HBM incumbents. Samsung, SK Hynix, Micron. They control the technology, the yield, the customer qualification, and the capacity allocation. They decide how much commodity DRAM the market gets. By choosing how much capacity to redirect to HBM, they are the gate. Their position is structural. Position 2. the commodity filler. CXMT, it has speed, it has scale, it has customers. It is about to have RMB 29.5 billion more in capital. But it operates where margins are set by the incumbent's capacity allocation decisions, not by its own competitive advantage. CXMT's pricing power depends on the three giants continuing to redirect capacity away from commodity DRAM. If they slow that redirection, the shortage eases. CXMT's pricing premium compresses. Position 3. The HBM ecosystem. Equipment makers, packaging providers, interposer suppliers. They sell picks and shovels to the gold miners. They capture value regardless of which DRAM company wins the share race. Because every HBM wafer requires their tools and materials. Their position is adjacent to the gate. Not through it, but durable. Position decides return. In the memory chain, the HBM gate is where the durable value accumulates. The investment question is not whether CXMT can grow, it is whether it can move from position 2 to position 1. From filling the hole the incumbents left, to holding the key to the gate they control. That move requires three things. Yield from 25% to competitive levels, access to the manufacturing equipment needed for volume production, customer qualification from AI chip designers. Each one is hard. All three together is the difference between a growth story and a position story. The IPO is a capital event, not an industry inflection point. RMB 29.5 billion buys faster commodity DRAM expansion. It does not buy the key to the HBM gate. CXMT broke a 30-year monopoly, revenue up 719%, profit up 688%. The second largest IPO in China's tech market history. But 99% of that revenue comes from commodity DRAM. The three incumbents are not fighting for commodity DRAM. They are leaving it. Moving capacity to HBM where margins expand and demand grows at 70% a year. CXMT grew in the space they vacated. It has not yet entered the space they are defending. Three locks on the HBM gate: process yield, manufacturing equipment, customer qualification. CXMT's own prospectus allocates zero dedicated HBM capital expenditure, RMB 29.5 billion in proceeds. Not 1 yuan committed to mass producing the fastest growing, highest margin product in its own market.
Breaking the monopoly isn't the same as owning the frontier. Next episode, we move from the memory gate to the computer gate. AI needs two things to run: memory and processing. CXMT showed us the memory side, speed into the commodity layer, gate at the AI grade frontier. The inference chip story is the same pattern from the other direction. China's AI chip companies are racing to build domestic alternatives to NVIDIA's inference GPUs. Some have a real silicon and real customers. Others still have roadmaps. Same gate, different chain. See you then.